Hello and welcome to Livewire Markets. My name is Anna Dadich. Today I am joined by Mike Schueller, Senior Portfolio Manager at Allspring Global Investments. He's going to be talking to us today about how Allspring capitalizes on market turning points. Hi Mike, thanks for joining us.
Hi Anna, thank you for having me.
We've recently rolled over into financial year, and Allspring utilises a 6-month investment horizon to exploit market inflection points. So if you could start with giving us a report card of this last 6 months. What did you get right? What did you get wrong? And it was quite a volatile period. So keen to hear also what your outlook is for the next 6 months.
Sure. Well, what did we get right? I would say at the beginning of the year, in response to valuations having become quite rich, we did de-risk our portfolio somewhat, and that left us prepared to take advantage of the volatility in early April with the tariff announcements by President Trump. So what did we do specifically? At that time, BB bond spreads, so these are high yield rated or so-called junk bonds, widened significantly. So those bonds sold off quite a bit, particularly relative to BBB bonds, which are higher quality bonds in the lower part of the investment grade space. So we felt there was a real opportunity given the significant widening that occurred in just about 2 weeks. And what we did was we sold BBB bonds and we bought two things. One was BB high yield corporate bonds, and the other were U.S. agency mortgage-backed securities. So the trade itself was designed to be risk neutral and took advantage of two sectors in high yield and agency mortgage-backed securities that we thought offered attractive relative value. That trade did work out really well as BBs outperformed BBBs. The one part of that we probably got wrong was we didn't add back longer dated BBB bonds quickly enough. Those also performed fairly well. So that was an opportunity that we sort of missed at that point. But overall, we found that to be a successful trade. I think the other area where we've been successful is in so-called curve steepening trades. So our view is that given global government deficits and increased inflation, we think there should be a higher term premium. And that's just a fancy way of saying that we think longer term bonds should offer higher yields. And we thought that they would move higher. And so we have had decreased exposure to that part of the curve, increased exposure to sort of the 3 to 5 year portion of the curve, because we do think it's likely that not only the Fed but other central banks will on the margin be cutting. So it gives us an opportunity to benefit from those cuts while avoiding the potential capital depreciation on the longer end of the curve.
So what about the outlook for the next 6 months?
We expect the U.S. economy and the global economy to slow somewhat, but importantly, we think we will avoid a recession. We do view tariffs as somewhat akin to a value-added tax, and so we think that is a bit of a headwind for growth. However, particularly in the U.S. where they just passed a brand new budget bill that increases the amount of the fiscal deficit, we do expect that to be an offsetting tailwind. So in 2025, we actually think that fiscal spending will more than offset tariffs. In 2026, we think it's about equal to the growth headwind that we see from tariffs. So, while we do see growth slowing, we expect that we will avoid a recession, and we think that's a really good backdrop for fixed income assets.
Okay, so focusing on the US for now, fiscal and trade policies, including recent large spending packages and tariff moves, have raised concerns around debt and contributed to rising bond yields. How are you thinking about this, and how does it influence your portfolio positioning?
This is a really important trend, and I would emphasize that it's not just in the US, but also in other developed nations as well. And we do see rising fiscal pressures that it will lead to greater issuance. And this ties back to what I was just saying about the potential for the long end of the curve, long rates to have to rise. And that is something that we're focused on. On the other hand, there are some countervailing factors. The rise of AI is going to improve productivity, which we think is a tailwind. And also, we're seeing goods disinflation being exported by China, which we think is also a countervailing force. So while we have some concerns about longer dated government bonds, we do think that for the most part, they'll be range bound at this point.
Okay. So you're currently overweight securitized after adding mortgage-backed securities in early April. Can you educate the audience about what that means and what this overweight says about your view of the world?
Our view of the world is that generally we think valuations are rich, and what we're trying to do on behalf of our clients is find high quality income for their portfolio. We do think income is a really, really important part of a fixed income investor's portfolio. So with respect to U.S. agency mortgage-backed securities, that is a very high quality income stream. And we think the fundamentals are positive in the U.S. Home prices are at really good levels, and volatility within the rates market is lower. So we think that's a positive for the U.S. securitized market, particularly U.S. agency mortgage-backed securities.
You've also added some duration recently, taking it out to 4.2 years, although this remains well below the 6.4 years of the benchmark. So 2 questions. Why have you increased duration, and why does it remain below the benchmark?
Great questions. So why have we increased duration? We think that inflation, while it's elevated relative to pre-COVID, it's about as good as it's been since the increase in inflation in 2022. But we think that combination of relatively well-behaved inflation plus a slight slowdown in growth opens the door for the Fed to cut at least 1 or 2 times by the end of the year. So we do want some exposure to that. We're particularly focused on the 3 to 5 year part of the curve, which we think will benefit the most from those cuts. As to the benchmark is over 6 years. We do think duration is an important ballast within a portfolio. If we do enter a risk sell-off, it is important to have rate exposure, but we don't think that the benchmark 6.2 years is necessarily the right duration exposure. We try to manage what we view as an investor's portfolio. We think 4.2 years does a good job of offering enough ballast should we see risk off, while providing our investors exposure to the potential for rate cuts.
Your outlook commentary mentioned concerns about policy mistakes and the risk of recession. How prepared is the portfolio if downside scenarios materialize?
Our focus in this environment is providing access to high quality, diversified income. And we've done that through not only U.S. agency mortgage backs, but global government securities throughout the world, and particularly in investment grade securities. Our allocation to the riskier parts of the market, including high yield, are on the lower end of our 5-year spectrum. And so we think that provides us the opportunity to generate good income if the bad things that we're worried about don't materialize, while giving us the opportunity to be able to allocate to the riskier parts of the market if those things do happen. As I alluded, we're relatively constructive on the economy. We think there's going to be a slowdown, but we won't have a recession. On the other hand, we are looking at tariffs that are at rates we haven't seen since the 1930s. We really don't have a lot of precedent for this. And when we compare that outlook and that situation to credit valuations that are near all-time tights, or the richest that they've been within the history of credit markets, we just don't think our investors are getting paid for those risks. And so we want to have the fund positioned so that we have ways to take advantage of any dislocations that we might see in risk markets.
Okay, so final question. The big question for income investors right now concerns interest rates. So globally, they peaked in 2023 to 24. How do you plan to continue to deliver compelling returns in a falling rate environment?
Well, a falling rate environment is a little bit of a tailwind, in that we'll get some capital appreciation from that. Having said that, we really actually expect rates to sort of be range bound about where they are, and that's just a reflection of these countervailing forces where, we do think the global growth slowdown will enable central banks to cut and provide somewhat accommodative policy, and we're balancing that against, particularly in developed markets, the amount of fiscal deficit spending causing an increase in supply, which creates some upward pressure on the long end of the curve, as we've discussed. But overall, we do think that yields right now are relatively attractive. And as I mentioned, the portfolio is positioned so that if we do have a risk-off market, we will be able to allocate to things like U.S. high yield or emerging markets, or those fixed income sectors which typically sell off in that kind of an environment.
Okay, great. Thanks, Mike, for sitting down with Livewire today and sharing your insights.
Thank you for having me, Anna.
If you enjoyed that interview, make sure to give it a like, and don't forget to subscribe to our YouTube channel, where we release new content every week.